gentlemen, good day and welcome to the Q2 FY2024 earnings conference call of SBFC Finance Limited, hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Renish Bhuva from ICICI Securities. Thank you, and over to you, sir.
Yeah, thanks, Nikhil. Good morning, everyone. Welcome to
I'm sorry to interrupt, Mr. Bhuva. Your audio is not clear. I would request you to kindly start the conference again.
Is it better now?
Yes, please proceed.
Hi. Good morning, everyone. Welcome to SBFC Q2 FY24 earnings call. I would like to thank the management team of SBFC for giving us the opportunity to host this call. I will now hand over the call to Mr. Sanket Agarwal, Chief Strategy Officer, who will take us through the brief introduction of the management team. Over to you, Sanket.
Thank you, Renish. Good morning, everyone. It's a pleasure to have the analysts, investors, and my colleagues in the call. I hope everybody had the opportunity to go through our investor deck and press release uploaded on the stock exchanges and on our website yesterday. I have with me Mr. Aseem Dhruv, Mahesh Dayani, Narayan Barasia, and Pankaj Poddar. The flow of the call will be that we start with the opening remarks from Aseem, followed up with detailed financial performance update by Mr. Narayan Barasia, and then we open for Q&A. Over to you, Aseem, for the opening remarks, please.
Thank you, Sanket, and good morning, everybody on the call. It's a lovely Saturday morning, and you guys had an option to chill with some chilled coconut water and watch an OTT series, but thank you for being on this call instead. Appreciate it. Our AUM, has been up 43% YOY and 9% quarter-on-quarter at 5,800 crores. Profit after tax at 53 crores is up 48% YOY and 12% QOQ. OPEX is down 70 bips YOY and up 10 basis quarter-on-quarter. GNPA down 13 bips YOY and 17 bips Q-on-Q. So basically, this led to a return on average assets, average AUM of 3.84%, which is 8 bips YOY and 12 bips up quarter-on-quarter. Thanks to the capital raise, the return on average equity came down to 10.4%, which is 32 bips lower YOY. And 159 bips lower quarter-on-quarter. Hitting 100 crore PAT this first half FY24 feels quite swell, as the Americans would say. Being a banker, continuing to accrue interest on an NPA account just didn't feel right, but that's what it is a regulation for NBFCs. But what we did was that from December 22, we did not take interest into an NPA account beyond 12 months into our P&L. Q1, June 24, we brought this down to 90 days. And this quarter, we have reversed the interest accrued for the 90 days for all NPAs. So effectively, we are now following the same reporting number procedure that banks do in India. As you would understand, this had an effect on our NIMs, spread, and credit cost, but we sleep easier having swallowed the frog. In September, we received our equity raise, so we are sitting on a CRAR of 45% and have committed but yet undrawn lines from banks and other institutions. So at the moment, we are swimming in liquidity. We opened 35 new branches YOY and 9 this quarter. We are in the middle of upgrading our tech stack with a new and improved version of our LOS as well as our LMS. And in the next couple of quarters, they should get rolled out. Opportunity exists. We have the capital and debt lines. We continue to go deeper into the states we are present in. Credit costs are holding steady at 80 bips. We have what we need. Now we just need to execute as we should. With this, over to you, Narayan, for...
Thank you, Aseem. Good morning, and thank you for joining the investors' call. Let us go through the financials and some key metrics before we move to Q&A. The AUM is at 5,803 crores, which has grown at a 43% YOY and 9% on a QOQ basis. We have seen a sharp increase in the interest rate globally and also in India over the last 18 months. Since majority of our loans, secured MSME loans, are on variable interest, we have been able to maintain the spreads of about 7.5% throughout the last 18 months. As a matter of prudence, interest income on the credit impaired assets which are classified as NPA is not being recognized unless we realize it. Accordingly, the company has reversed 6.2 crore in quarter 1 and about 4.1 crore in quarter 2 of the current financial year for the interest already accrued as one-time impact. The operating leverage has been improving consistently. Hence, the OPEX to AUM ratio has reduced from 6.2% in Q2 last year to 5.5% in Q2 of current financial year. Our GNPA remains steady with improvement at 2.3% with secured MSME of 1+ being steady at 5.27% of AUM, thereby leading to credit cost of 0.8% of AUM. Pursuant to AUM growth of 43% on a YOY basis, we have recorded PPOP growth of 46% on a YOY basis and PAT of 453 crore with a YOY growth of 48%. On a QOQ basis, AUM has grown at 9% with a PPOP and PAT growth of 12% respectively. CRAR as of September 30th, 2023 has substantially increased to 45% due to an equity raised by way of an IPO with tangible net worth of 2,339 crore as of September with sufficient liquidity of about 1,000 crore as of September 2023. Thank you. We now open for the questions, please.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take the first question from the line of Renish Bhuva from ICICI Securities. Please go ahead.
Hello. Yeah. Thanks for the opportunity. So just two questions from my side. One is on the growth. So till last quarter we have been guiding it around 5 to 7% sequential growth. But now when we look at the first half or YTD growth, it is already touching 17%. And, considering the second half generally is better than the first half. How one should look at the guidance range of 5 to 10%, which we always used to highlight, sir?
No, so I don't think we're changing the narrative. So the narrative remains at 5 to 7. So if you look at for the quarter, so the quarter was close to around 8.9. So it's not significantly different from what we've always been talking of. And I think the entire piece of, if you probably look at our previous quarters as well, the whole idea of a last quarter being significantly different from quarter 3, I don't think we'll see those lumpiness over the period of time. So the whole idea is that it's going to be a lot more even as we move along. And hence we've been talking about a range-bound growth rate of between 5 to 7. The second part is I think we're pretty comfortable, with this, considering that the distribution that's been built up is fairly young. If you look at our branches that have come up, have also come up, almost 35 branches have come up in the last 12 months. So we really don't want to accelerate too much in the first initial years. So we've been a little cautious and we're pretty comfortable. Yes, what we would want to do is that positively surprise you, but the guidance would continue to be between 5 to 7.
Got it. And secondly, again on the spread side, last 3-4 quarters, the spread is actually sustaining at 7% plus, even after adjusting for this 7 crore last quarter, 5 crore this quarter interest reversal. So what sort of a steady state spread one should assume for, let's say, for a business like this?
So, if you remember, probably in the last call also we maintained that our book is largely floating. So our entire MSME book, almost 98.5% is floating. And hence what we always maintain is that we're pretty comfortable on the spreads that we are maintaining. And we should be able to continue to maintain the spreads above 7%.
Okay. That's it from my side. Thank you and best of luck.
Thank you.
Thank you. A reminder to all the participants, anyone who wishes to ask questions may please press star and 1 on their touchtone phone. We'll take the next question from the line of Jigar Jani from B&K Securities. Please go ahead.
Yeah, hi sir. Good morning and thanks for taking my question and congrats on a great set of numbers. I just wanted to check on the asset quality front. So if we look at in terms of the stage 2 numbers, there has been a little bit of a spike in this quarter if you see it sequentially. So, any particular reason why the stage 2 numbers have gone up?
Stage 2 numbers, as you look at 0 plus overall has improved and stage 2 number has been stable in terms of percentage. So, if you look at on the percentage stand, we are comfortable with the and the numbers are stable.
Yeah, so I was just looking at like last quarter you were at 3.7 for Q1. And this quarter it is gone to 4.4, so nothing exceptional to read into it. Seems like a seasonality impact, is it?
Yeah. So from a portfolio standpoint, we are not seeing any kind of stress.
Okay, understood. And just wanted to check this 1 DPD numbers that we report. That is just for the MSME segment, is it?
Yes.
And the when I have to compare it, it is not like to like comparable with the gross stage 2 and stage 3 numbers because that is on the whole book, right?
It would include all products, the secured MSME. So for secured MSME, if you look at stage 2, the percentage is improved.
Okay, understood. Okay, and sir, on the margin, I just missed the last commentary. So you're mentioning that spreads will be able to maintain above the current levels of H1, which is 7.3%, you're saying?
Yeah, so we've been guiding that the spreads would be above 7%. And, our ability to price the book is significantly high because almost 98.5% of the book is floating. So barely 1.5% is fixed.
Okay, understood. And sir, where do you see this OPEX to AUM eventually settling for the business as an overall? If you could guide something on the OPEX and the credit cost, that would be great.
Yeah, so on the OPEX side, what we've been saying is that largely on an annualized basis, we should see the distribution sweating almost 50 basis points on a year-on-year basis. Last quarter, we were lower by almost 12 basis points. And we feel that all through the year, we will be able to achieve close to around a 50 basis points reduction.
Right, sir. And on a steady-state basis, credit cost should remain sub 1%?
Yes, that's what we've been guiding below 1%.
Okay, great, sir, great. Thank you so much for answering my questions and best of luck.
Thank you.
Thank you. Participants who wishes to ask questions may please press star and 1 on their touchtone phone. We'll take the next question from the line of Ashish Sharma from Enam Asset Management Company. Please go ahead.
Yeah, hi. Thanks for the opportunity. So just wanted to check on two things. One is on the branch expansion. How should we see from the current number, from a medium to long perspective, branch expansion happening? Do we have a strategy to penetrate all the states? Just some color on that. And second would be on the yields part, sir. So again, currently the yields as per presentation mention is 17%. So from a medium to long term perspective, you see yields remaining in the same range. Just some color on that also will be helpful, sir. Thank you.
Yeah. So to answer your first point with respect to distribution, we've been maintaining that the last 4 years, 5 years in the build-up, we had grown or we had built horizontally, which meant that we had invested in states. And now, since last year and moving forward, we need to penetrate in each of the states where we've spent significantly in building our distribution. We are very comfortable in adding 20 to 25 odd branches in a financial year. We were close to around 150 and we are now 171 in the first half. So that's around 20 odd branches. The rationale is that if you have most of the branches come up in the first half of the year, then you tend to stabilize and get the benefit in the subsequent 2 quarters. So if I were to guide with respect to the branches and distribution, we are not adding any further state to the existing distribution that we have, but we will penetrate deeper in the markets where we have color and comfort on the origination that we do. And 20 to 25 branches in a year we are comfortable adding moving forward as well. As far as your question on the customer yields is concerned, the customer yields are roughly close to around 16.5%. The 16.5% we feel is comfortable. Some basis points here or there, but largely it's going to be in that range of 16.5%.
Okay. And any read-through in terms of asset quality, because there was few comments by, other players regarding the leverage and in the rural sector. Anything you have touched upon? As of now, you already mentioned that asset quality remains comfortable, but any signs you are seeing or it's okay?
So from our ticket sizes, we are largely not in the rural markets. So if you look at our distribution, I think one of the slides in the presentation maintained a core focus segment. We are typically in a segment which is between 5 lakhs to 30 lakhs. That's our core segment. And we're in the non-rural market. So far the portfolio trends that are emerging tend to be stable. And we're fairly hopeful of holding on to the current levels as well.
Perfect. Thank you, sir.
Thank you. Participants who wishes to ask questions may please press star and 1 now. We'll take the next question from the line of Shubhranshu Mishra from Phillip Capital. Please go ahead.
Hi, good morning. Thanks for this opportunity. One is, what is our match maintenance rate? Second, what percentage of our collections are cash collections? Third, what is the 0 plus? And what is the rollback from the what is the rollback rate from the first bucket? Thanks.
Can you explain when you say what is maintenance rate? What do you mean?
So if we have, say, 100 customers who've got match mandates, how many of them really get through on the day of banking?
Okay, so we have closer to 97-98% attrition rate from activation rate on the NAT side. On a full year, on a sustainable basis. And at the time of booking, typically we take match mandates in 100% of the cases. So at later stage, we see some of them drop off. From a collection standpoint, 8% collection is, so 92% is non-cash and 8% typically would be cash. On the 0 plus, the number has been mentioned, it is 5.27%.
And the rollback rate from the first bucket?
We'll have to check and get back to you with this number.
Sure, thanks.
Thank you. The next question is from the line of Bhuvnesh Garg from Investec Capital. Please go ahead.
Yeah. Hello, sir. Good morning. So thank you for the opportunity. Just want to, so I'm looking at the presentation. I see the share of gold loan is declining consistently. So just want to understand your strategy, that where do you see the product mix moving, and any dynamics you can share about the gold loan and why is it declining?
Yeah. So if we really look at from a branch distribution perspective, we have 150 odd branches which do gold out of 171. Our average AUM per branch is close to around 6 odd crores. and that's where the total number is 900 odd crores. The whole idea around the branch strategy for gold has been that our average AUM has to start moving up, and we're looking at the entire product from a profitability perspective. But moving forward, what you would tend to see is that as we keep expanding our network and branches, gold is going to be a part of it. But what we've always guided is that you will tend to see almost 85% dominated by MSME and 15% is going to be gold. Why is that percentage tilting towards MSME is because obviously the ticket sizes for MSME is closer to 10-11 lakhs, whereas the ticket size for gold is close to around 80,000 or 85,000. So by design, what you would tend to see is that it's going to tilt towards MSME, and gold is obviously going to be a lower percentage of the overall AUM. But if you look at as a standalone matrix, it's going to be in line with most of the peers that you have.
Okay, so you are saying 85% eventually would be MSME, and then around 15% would be gold over.
Currently, we should be around 80 to 83 odd % is MSME, and the balance is between gold and others.
Okay. And sir, any color of in terms of competition, basically what kind of yield we offer in gold loan, and any color on competition dynamics in gold sector?
So I would say compared to last year, the yields have stabilized. Obviously, if I were to give you some color on the overall markets, so the large tickets are dominated by banks. The smaller tickets become the domain of most of the NBFCs. And I guess both segments are extremely independent and exclusive, mutually exclusive. Yields have largely stabilized for most of the peers, and they are in the range of 17 to 18 odd %. We are also in that particular band.
Got it, sir. Got it. And in terms of our co-origination portfolio, so if you can just share some details about the arrangement with the counterparty, and is it same as co-lending? I mean, is it same, or what's the broad contours of arrangement?
Yeah. So this is the circular one where the origination happens at a real-time basis at both the organizations, along with us and the co-origination partner. The ratio is 20 and 80, and at the time of disbursal, both the disbursals happen at the same time, which is very unlike the second circular. The commercials is something that we don't call out, but clearly it's a great tool for us both on the liability side and it's an ROE enhancer for us as well.
Okay. And there is no any FLDG kind of structure where you are taking.
There is no FLDG, and risk is on a pari passu basis.
Pari passu basis. Okay. Great, sir. Great. That's it from my side, and thank you for the responses. Have a good day.
Thank you.
Thank you. You may press star and one to ask questions. We'll take the next question from the line of Nilesh Jethani from BOI Mutual Fund. Please go ahead.
Hi, good morning, and thanks for the opportunity. So my first question was on the growth side. Say hypothetically, if I want to understand without even adding one branch, so what can be the growth expected? Basically, if I wanted to understand where the AUM per branch, etc., from current levels can go up to, if we don't add even a single branch, what can be the growth expected?
So if you look at 170 odd branches and you look at our total AUM currently, which is close to around 5,800 odd crores, we should be closer to around 33 crores per branch. If you look at our branches which are maturing, which are more than 3 years, you would see them inching more towards 43 odd crores. If I were to answer your question that if we don't add a single branch, this 43 would probably ultimately mature anything between 45 to 50 odd crores. So if I were to look at 170 branches and multiply that by 50, you will get 8,500 odd crores.
Got it, sir. That was helpful. So second question was on this branch addition target of 2025 per annum. Wanted to understand whether this could be newer states or we are focusing on the existing 1 or 2 states where we are more confident on.
Yeah, so we're not adding states because on the secured side, I think there is significant amount of investment that's required right from origination, credit, risk, audit, operations. So there's a whole deal of investments that you need to do, and most of those investments have already been done in the existing states. We would continue to remain invested in the states where we are already present, but now go deeper in those particular markets, depending upon the credit outcomes, our behavior, maturity of the portfolio. So we're not adding any further state, but will remain invested in the existing ones.
Got it, sir. And so my last question was on the NPA cycle. So just wanted to understand, since our book is also very new and the growth rate has been very faster for us, but in general, if you have to take the 7, 8, 10 years period, typically in the segment where we operate, say SME or small business loans, what are the best NPA or GNPA one can expect? What are the best case provision one can expect, and where are we today and what can be the outcome in a very normalized situation?
So see, in the segment we are, if I take secured MSME space, typically we see the delinquency peaking at 36 months tenure. So on a vintage basis. So based on that, the coincidental GNPA numbers which we are seeing is in the range of 2.2 to 2.5%, and a lag level can be higher, but at a vintage level, if you look at that, translates into a credit cost of 80 to 100 basis points and LGD of 30%. So based on that, the model has already been baked in, and we are comfortable with sub 1% credit cost guidance in long run.
Just to add and probably give you some color on the industry landscape. So if you look at the segment of 5 to 30 odd lakhs, so the total size of the market is close to 2.5 lakh crores. That's growing at above 20%. So that's a good runway for growth. But if you look at the peak delinquency, which was probably post-COVID, that was a number which was closer to 5 odd percent. But in that, the NBFCs did a better job. The banks, cooperative banks and other players in the segment probably did a poor job. So we feel that probably our gross NPAs are going to be significantly better than what the industry puts in. And as Pankaj rightly mentioned, that we've been conscious of, while we're growing the book, we've been conscious on how the 0+ is moving out, and our gross NPAs, which ultimately translating into the credit cost, and what we've been guiding is that it's going to be sub 1%. So on a risk-adjusted basis, it spans out extremely well, because if you are lending at almost 16.5% and you manage to keep your credit cost sub 1%, this ultimately is an ROE accretive model for this segment.
Got it, sir. And so one question on a very longer term basis I had with regard to yield. So when we speak to your peers, they clearly come out and say that customers there are non-bankable and new to credit, so charging them a X percentage of yield is very convenient for them. But for someone like us, SBFC, so typically we are in the peripherals of the urban areas where I believe a lot of customers won't be new to credit, but also would be having some bankable or the credit history. So what gives you confidence of charging the current interest rate over a longer term period?
So, if I were to split this, I don't think there is a luxury to charge customers any amount of interest rate, because obviously customers are becoming increasingly sensitive. But if I were to probably break this into two parts, one is related to your ticket sizes. If you look at ticket sizes which are in the range of 2 to 4 lakhs, probably the yields are going to be upwards of 19 odd percent. As the ticket sizes keep on moving, then obviously the yields keep on coming down. That's because of two reasons. One, you're getting closer to the metros, where the competitive intensity from large NBFCs and banks is extremely high. And second is obviously you have a tested customer who comes in to play. If you look at our customer profile, and a lot of that information is captured in the investor deck, you will realize that almost 85% of our customers have a CIBIL score of more than 700. They are borrowing against a commercial property or their own property for the first time. They have a bureau score, which means that the score could originate from a consumer durable or any asset that they would have borrowed. But there is some history. But they're borrowing against a property for the first time. And that number is close to around 75 to 85%. So if you are looking at those set of borrowers, yes, you have some flexibility in able to price your customers. But as you move along into the journey and they get tried and tested for, with you for 3 and 4 years, ultimately they will transit into larger banks with a competitive interest rate. It's just our ability to price them in their initial journey is high, but eventually the MSME segment is going to land, which have a good track record with them, into a lower pricing with the larger banks.
Got it, sir. So, sir, directionally, today the leverage, etc., is slightly lower for us. But as we move in and leverage increase, what's the best outcome leverage one can work with as far as SBFC is concerned? And with increasing leverage, any calculation which you guys would have done with regards to how the NIM will perform as we take up more and more equity?
So, our leverage post the equity raise through IPO has reduced significantly. Our CRAR has moved pretty well. So, from a medium-term to long-term perspective, so if you look at all the bank's covenant we have given, allows us to go to a debt equity of 5. But, looking at the macroeconomic picture, we believe that somewhere between 3 to 3.5 is the right leverage to debt equity to achieve. I think keeping that in mind, obviously, the return on equity will then subsequently increase and improve from where we are today. And your question on NIMs, obviously, with the high debt coming in, the NIMs slightly compresses. Assuming that the spreads are maintained and everything is status quo, the NIMs obviously come up, but the ROE is significantly improved.
So any calculations internally you would have done with regards to how the NIMs will move with every reduction in the capital adequacy ratio?
See, this is simple. So if you assume that the spreads are constant, you can work at a different leverage numbers. So assuming that all things remain the same, how the things move is an easy exercise to be done. But the important thing is, which any NBFC would like to have, is the ROEs improve from where we are today.
Okay, got it. Those were my questions, and thank you so much for replying to them. All the best.
Thank you.
Thank you. We'll take the next question from the line of Bhuvnesh Garg from Investec Capital. Please go ahead.
Yeah. Thank you for the follow-up, sir. Just on this co-origination bit. So I see that most of our peers are either on co-lending model or direct assignment model, but we are going with co-origination route. So just want to understand what's the thought process behind going for co-origination, not for co-lending or direct assignment, and what's the difference in terms of yield, etc. in these three models? Yeah.
So see, the way it works is that co-origination was the first circular that came from RBI, and that was a very superior circular that came, because what you get there is that there is a risk. There is not just a risk participation, there is also an understanding of risk that is brought into the transaction upfront by both lenders. So we have an arrangement with ICICI Bank where we originate a case. We look at credit. We select the customer. It's a jointly approved product program. So ICICI Bank has also applied its own thought on the product program, and then it goes to their credit buyer for approval. So their credit buyer also adds value. They have a lot more experience than us. They have seen a lot more winters than us. They also add value in terms of guiding us on whether this is good credit or not good credit. So there is one more level of credit screening that happens on every case, and then the transaction gets done. Also, what happens here is that effectively, it becomes we get a better credit outcome on a co-origination transaction. Second is that the risk participation is pari passu, because it is by logic, because it is both the people have looked at credit upfront, so therefore both have bought individual credit. They have not taken a risk on us. They've actually bought the credit of that individual transaction. However, all good things in life are difficult to do. That's a central rule of life, that if it is a good thing, it will be difficult to do. So co-origination became very difficult to execute, and I believe we are the only substantial co-origination arrangement in the market. I'm not aware of any other NBFC with significant volumes in the co-origination business, and which is why RBI came out with a second circular, which was the easier circular of co-lending, where it is simply direct assignment with a different name. So what all co-lending is a direct assignment with the minimum holding period taken out. So it's a much simpler transaction, and therefore it took off and everybody participated. But in that, the bank is not really and has not really bought the risk of the transaction. It is more like a direct assignment, and the bank has done a portfolio selection. So the risk outcome of that will be different. Plus there are stamp duty implications and all, etc. So for the way we look at it, coordination is a much superior model based on both credit outcome as well as in terms of profitability. It's a asset-light, ROE-happy model. So we have focused on what is the more difficult thing to execute. We worked hard on integrating technologies. So we had to do an API linkage, into the bank, because the bank has to see the file digitally and approve it regardless of which location. Two credit buyers could be in a different location. If I'm originating a file in Nagaon, in Assam, it is not necessary that my credit buyer could be sitting in Nagaon, but ICICI credit buyer could be sitting in Guwahati. So I should have the ability to digitally show the file, to them, and they should be able to instantly approve the transaction or decline the transaction, and we come to know of it. So we have to build all these API linkages. It is a tough thing to do. It took us time to build this, but in the end, it's been a happy outcome.
Got it, sir. Got it. Understood. And how does the interest rate work, sir? Because I understand that ICICI Bank would be having, say, lower interest rate, but our interest rate would be higher. In that case, in co-origination model, how does the interest rate works out?
So the interest rate, when it goes to the borrower, it's a weighted average interest rate between the NBFC and the bank. So 80% weightage is to the ICICI's interest rate, and 20% weightage is to our interest rate, and so the combination of rate is given actually to the borrower. So obviously our interest rate is definitely going to be higher than what ICICI Bank's interest rate is.
Got it. Understood. Yeah. Thank you, sir. That's it from my side. Thank you.
Thank you. A reminder to all the participants, anyone who wishes to ask questions may please press star and 1. As there are no further questions, I would now like to hand the conference over to Mr. Asim Dhruv for closing comments. Over to you, sir.
Thank you. Thank you, everyone, for being on this call and taking the time out. Also, incidentally, tonight is the lunar eclipse, and at 11:30, I think, while your guys' daily job is to, find the moon behind the clouds of data that is there. Today you may actually get to see the Earth between the sun and the moon. So it would be a wonderful sight. Do watch it. Thank you so much for the call, and look forward to the next quarter and the next call and the interactions thereafter. Thank you very much.
Thank you, members of the management. Ladies and gentlemen, on behalf of ICICI Securities, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.